Good day, fellow investors. If you put your money in stocks, you'll get 10%. Well, sometimes yes, sometimes not. But if I look at the general mantra out there, Tony Robbins going all around the world saying how if you invest in the S&P 500, you get 9.2% compounded. If you invest in private equity, you get 14%. If you invested 1 million in the stock market, you get 26 million today. Same 45 years, it's worth 139 million. The first thing is, yes, if you look at the last 30 years, stocks did their 10% per year, and stocks can only go up, right? Then on the private equity, don't chase Anthony, please, because private equity boomed in the last 25 years, and that's exactly why Anthony Robbins uses that perspective, because interest rates went from 6 to 0, which means that asset prices, private equity, go up, and that is why the private equity mania went ballistic here in the 10 years, decade 15, because interest rates were 0. And then if you can borrow at 0 and invest at 4 or 5%, all asset prices explode. Anthony Robbins would be talking a different game if this would be the environment over the last 20 years when interest rates just go up. So private equity in this environment would get sledgehammered. And then when it comes also to stocks, yes, stocks did great the last 2 decades, 1 decade, but people forget to look about the cycles, because here from 1929 to 1985, real returns were 0. Look at this. Stock market, 55 years of 0 returns. 55 years, just dividends and just inflation. That is also the stock market that nobody talks about. And let's go to some academic research, because I have learned from Ben Felix that I have to put academic research in each of my videos. And here we go, Financial Analysis Journal 2024, Professor McQuarrie. Let's go. Stocks for the long run, sometimes yes, sometimes no. And the abstract is that looking at data, updating the quality of the data shows that stocks sometimes outperform bonds, sometimes bonds outperform stocks over multi-decade periods, and sometimes they perform the same. Let's look a little bit deeper, and this is the antithesis to Jeremy Siegel's stock for the long run, where stocks only go up and everything else is terrible, so at whatever price you have to put your money in stocks. Let's dig deeper into this beautiful article, and you can see here how they have updated the data, because now we can get better data than what analysts and academics could get in the past, and you can immediately see how sometimes bonds outperform stocks, sometimes stocks are decisively superior, sometimes it is the same, but this perhaps will show it even better. If we look at all data, and if we look at holding periods in years, of course, the longer you hold, the more likely is that stocks will outperform bonds. But there were also periods where stocks didn't outperform. Sometimes it was much, much better. So that is something that also is skewed when it comes to the stock market, depending on the time frame you are looking at. And to put things into a perspective, the thin blue line here, 20-year stocks returns analyzed. Let's look a little bit at the 20-year rolling returns. So you can have high returns and then also low returns. High returns, high returns, low returns, high returns, high returns, low returns. If you look at the average from 2000 to 2020, 17, returns were pretty low. But if you go for 30-year analyzed, then you see that the line there, the returns, the lows are a little bit higher, but also the highs are a little bit lower. And that even continues with 50 years, so you can see the lows go to 4%, the highs to 8%. And that is about it when it comes to the stock market. So everyone is talking about 10%, while reality is 6% real returns, with lows from 4% to highs of 8% real returns. And then you look at how bad it can get from stocks. You can have 50 years with annualized returns around 4%. That can be the outcome. 30 years with 2-3%, and especially worst equity returns 20 years at practically 0 or 1%. You're not getting rich on that. If the market turns, all you have left is the dividend yield. 20 years you stay at the 1%, then the dividend grows over 30 years, you get to 2%, and over 4 years, 1% to 3% growth, you should get to the 4% return going forward. And that is also explained in these charts and in this beautiful chart. So when it comes to all those expectations, you look at 20 years, you can expect practically no returns for 20 years. 30, a little bit better, 40, a little bit better, but 4% is not the 10 everyone is sounding about, and especially not the 14% Anthony Robbins thinks to get from private equity. And then when it comes to bonds, of course, bonds did well until the money was separated from gold, and then we have this terrible situation for bonds, then good again, and now depending on interest rates, we'll see where it goes. Buffett has sold stocks because he knows the long-term returns now, and he went into 3-month treasuries, so that's cash, not really long-term bonds, so this is not effective to Buffett. Further, we can look more at the data and we can see how internationally you have terrible returns for 20 years. So much about international diversification being better. So you can have really, really bad returns going forward when it comes to real returns. Now we are in a, let's say, bubbly period and things look good. But if stocks just revert to the mean historically, then you are here at $1 to $3. So that's not much over 70 years of holding, especially given the current 1.2% dividend yield. And when it comes to the implication for investors, you need to know what you are doing and not always just bet on stocks, whatever thinking. And what is the solution? Let's go to further academic research. I found this article from a guy called Sven Karlin, Amsterdam University of Applied Sciences. It's an older article, it's on emerging markets, a real value risk estimation model, and from talking to the author, he explained how all these ups and downs, long-term, high and low returns, can be explained by looking at the fundamentals. Very smart guy. And you see now the fundamentals, the current Shiller P/E ratio is very high, 2000s, 1960s, 1929. And then if we look at returns, 1929, 55 years of zero returns. We have had from 1968 to 1990, 25 terrible years. So things do not go as you plan. From the 2000s, if the markets just revert to the current interest rate, we are at 25-30 years of zero returns. To do well, whatever happens with the market, you have to focus on dividend earnings. We don't know what inflation will be, but if we own good businesses, if inflation is high, we'll do well. If inflation is low, we'll do well. Warren Buffett knows it because he knows how markets work. Everyone else is there saying private equity 14%, good luck with that in this environment. Stocks 10%, good luck with that in this environment. Thanks for watching. If you want reality, stick to this channel.